Hi there and welcome to our brand new finance channel. I'm Nikki Mirchandani, an ex-media anchor turned digital content creator. Today we're going to be talking about a company that you and I both know of, Swiggy. Now this food delivery giant backed by SoftBank is gearing up for a big moment. They're launching their IPO from November 6th to November 8th, aiming to raise a little over 11,000 crore in what may be one of the largest IPOs by a private Indian company this year. So grab your snacks and let's get into all the juicy details about Swiggy to understand if it's really worth the hype. A bit about this company. With Swiggy, you can look at lots of yummy foods and order them to be delivered right to your house. You can also use something called as Instamart to get groceries and household items quickly. If you want to eat out, you can use Dine Out to book a table at a restaurant. For an event, check out Stepping Out, and if you need something to be picked up or dropped off, Genie can help with that. This is the basic understanding of the company. Okay, let's get to know more about the company. Swiggy IPO will open on November 6th, close on November 8th, expected to be listed on November 13th. The price band is between 371 to 390. You can buy them in groups of 38 shares, which is called a lot. The total size, like I mentioned earlier, is 11,000 crore. But just to give you a split, 4,500 crore will be coming in from fresh bits and 6,800 will be coming in from the shares being sold by other existing investors. And here is a little perk. Employees can get a discount of as much as 25 rupees per share. Now let's understand the lot size. For retail investor, the minimum lot size is 1 lot, which is 38 shares for 14,820 rupees. Maximum limit is 13 lots. Now, for small HNIs, the minimum is 14 lots, costing around 2,07,480. And for big HNIs, the minimum is 68 lots, costing around 1 million odd rupees. Now, the company proposes to utilize the net fresh issue proceeds towards funding the following objects. First is the investment in the material subsidiary, Swiggy, for repayment of all its loans. Second is going to be the investment expansion in the material subsidiary, Swiggy, of dark store network for quick commerce segment. Third will be funding its inorganic growth requirements. Now let's understand some of the strengths and risks of the company. Strength first point would be brand recall and pioneers in high frequency hyper-local commerce segment. Now Swiggy is a standout company. It's the most valuable brand in consumer technology and services platform category and ranks amongst the top 25 most valuable brands in India overall. What makes it special? Well, Swiggy is the only app in India that helps you with all your food-related needs, whether you're ordering in, dining out, or cooking at home through its own platform. It is the first hyper-local commerce platform and it's well recognized as a leader in the hyper-local commerce segment. Now, what do I mean by hyper-local here? It refers to services or businesses that operate in a very specific localized area, usually within a few neighborhoods or small community. Let's understand the second key highlight, consistently growing network of users. The company has seen consistent growth in its monthly transacting users, which means more and more people are using the app for both food delivery and quick commerce. As of June 2024, Swiggy has hit an impressive milestone. 112.7 million users have transacted on the platform. That's a huge number and shows just how popular Swiggy has become. Well, third key highlight is the experienced professional management team. Swiggy is led by an awesome team of dynamic entrepreneurs and experienced professionals who really know their stuff. One standout is their Chief Technology Officer, Madhusudan Rao. Before joining Swiggy, he worked with big names like Boomerang and Amazon, so he brings a ton of industry expertise to the table. Now let's talk about some of the concerns, right? First point is reported losses since inception. Swiggy has faced financial challenges, reporting in losses every year since it started in December 2013 with negative cash flow from operations. Originally a food delivery service, Swiggy has expanded to include quick commerce, Genie for pickup drop-off, dine out, and hyper-local commerce with Swiggy Minis. While its revenue has grown, significant expenses for advertising and promotion have led to ongoing net losses. Now let's talk about the second concern that I have for this one. Material subsidiary Swiggy is loss-making too. Swiggy's material subsidiary Swiggy has faced losses in the past. If these losses continue, they could impact Swiggy's overall financial health and consolidated results. By the way, the company is raising funds for prepayment and expansion of this loss-making subsidiary Swiggy. Competitive landscape is the third key concern that I have in mind. Swiggy operates in a highly competitive hyperlocal industry between 2018 to 2023. Online food delivery market grew at a remarkable 42% CAGR, while quick commerce segment saw even faster growth at 148 to 169% CAGR. This rapid growth is attracting many new players to the hyperlocal market. Some of Swiggy's direct competitors include Zomato-owned Blinkit, Zepto, Easy Dinner and BB Now, which is Big Basket. Further, Amazon is also pouring into quick commerce segment in a big way. Let's talk about financials now. The company has registered 35 to 40% growth in its top line performance in FY22 and FY23, but has remained loss-making since inception. It's loss-making even on an operational level. But it remains to be highlighted that Swiggy reduced its losses for FY24 to 2,350 crore, down from 4,179 crore in the previous year. Now let's talk about the comparison between Swiggy and Zomato. Zomato leads the race. It has surpassed Swiggy on a lot of parameters like gross order value, restaurant partners, and average monthly transacting users. It also has a higher average number of monthly transacting users in both food delivery and quick commerce. Zomato leads in gross order value across all the categories and has larger number of restaurant partners. It also has a higher average number of monthly transacting users in both food delivery and quick commerce segment. Zomato's market capitalization is almost double of Swiggy. Now let's look at the revenue share between the two companies. Swiggy and Zomato both primarily earn from food delivery, with Zomato at 57.5% and Swiggy at 49.4%. Zomato has a larger quick commerce segment at 17%, while Swiggy is at 8.8%. Swiggy leads in supply chain revenue at 38.8% compared to Zomato's 23.4%. Overall, Zomato relies more on food delivery, while Swiggy has a stronger focus on supply chain services. Let's talk about the numbers. Swiggy's sales are currently lower than that of Zomato's and still operating at an EBITDA negative, meaning it's a loss-making entity. In contrast, Zomato has turned things around and is now profitable on the EBITDA level. This remains to be an important parameter to be noted. Now, would you like to subscribe to this one? What is the grey market premium indicating? According to SBI Securities, Swiggy's IPO is priced at the upper band of 390 rupees per share. This gives it a price to sales ratio of 7.8 times and an EV to sales multiple of 7.3 times based on FY24 numbers. On being compared to Zomato, Swiggy's valuation looks fairly priced across the board. Based on this analysis, SBI Securities recommends that investors can subscribe to the Swiggy IPO for a long-term investment perspective. How about the grey market premium? Don't expect a big splash with this one. It's likely to have a flat start. Why? Well, the IPO is hitting the market during a tough time, with concerns about slowing urban demand and foreign investors pulling back from the domestic market. To make things even more cautious, we just saw Hyundai Motor India's recent listing also being lackluster. Now, let us know your thoughts in the comments. Don't forget to like and subscribe for more market updates.